Welcome to the deep dive video update. And I want to explain this because I use the term deep dive in probably a little different context than what you might think. I look at hundreds of charts every day and I put those charts into various videos throughout the week. What I do at the end of the week is I go through all those charts, and the charts that I didn't really use in the videos, I put into this video. And the reason I call it the deep dive video is we have to look deeper to see if we're being told anything that maybe we're missing that we're seeing also in other charts. There are also some charts that are only unique to this video. So I put them all together and present this particular video every week. This is being prepared for Monday, January 6th. The first chart is a chart of the VIX. The VIX is invisible on this chart, but over top of that is a 50-period exponential moving average. The idea behind this chart is we get a sense of the range of the VIX. When we're in a more positive environment, the VIX is lower. When the VIX is low, we tend to do better. But when we go up into a higher range, that's when the VIX really goes up and stays up high. And you can see back in 2020, of course, that's the COVID crash. Then we came up out of that. Then 2022 was a very difficult year for the market. And we've been coming down as the market's been going up. We have been going up lately, and this happened kind of around the election time, the uncertainty and everything that was surrounding that. Then we were starting to come down as the market was going back up. We're ticking back up right now because the market has been under some pressure as we end 2024 and go into 2025. But the takeaway from this is we're in this lower range. It's right around 16 currently. The lower the VIX goes, the higher the market goes. We get to a point with the VIX when we get to a very, very low reading, and that's when we use this as a contrarian indicator, meaning that there's really no fear out there. And then we use other indicators as well and say, okay, people are getting a little too complacent right now. Maybe we should get more defensive. So I just use this for information, just to see what's happening with the overall VIX. Also, another study that I do with the VIX is a correlation between the VIX and the S&P 500. We're still getting a pretty low reading right now. When we get above this dashed line, it means the market is getting pretty nervous. And we may not always see that with our other sentiment gauges, and we may be picking that up here. Well, right now, we are picking it up with some other indicators that we use. This one really isn't telling us much right now. We look at the VIX, and then there's another indicator that goes along with the VIX called the VVIX, or the volatility of the VIX. And we do a ratio between the two. As a general rule, there can be times when this really goes up, and that can often mean that the VIX is going faster than the volatility of the VIX, and that tends to be more negative. We've been kind of going up and down throughout 2023 and into 2024. We're flattening out right now. Not really getting a lot of insight from this. We're getting some really good ideas about what's happening by watching the VIX itself. Then we measure the speed of the VIX, and there are times when I use this in the daily video. It just means that we're going up or down really fast, and I use an RSI based on 9 periods to measure that. Then we look at the correlation between the volatility of stocks measured by the VIX and the volatility of bonds measured by the MOVE index. And we kind of see that we're chopping sideways. We had really spiked up and then we're coming back down, and we're kind of going around here, just seeing what's happening with volatility. Now, sometimes in a more positive environment, as the S&P has been going up, we'll see this red line, the moving average, excuse me, actually continue to go down. And then when the market's under pressure, we might see this red line going up. But that's not always the case. There's a time here back at the beginning of 2024 when this red line was going up and the S&P was going up at the same time. So we don't want to read too much into this. This just gives us some insight about volatility between stocks and bonds. Then, just for informational purposes, where are we in terms of previous significant levels with the S&P 500? We're up 23.32% from the previous all-time high that was set in January 2022. before we went into a cyclical bear market. Then we finally bottomed in October of 2022, and we've been going up ever since then, up over 70%. And then we hit another significant low back in October of 2023, and we're up over 44% since that time. Just this is just a gauge to let us know how things have changed over time on a percentage basis. Then stockcharts.com puts out alerts, and these are not only for the S&P, but all the main indexes, a lot of sectors out there. And what you see here is really kind of a shorter list than usual because of the holiday week. If it's red, it's negative. And earlier in the week, the market had been under some pressure. And this positive sign here for the dollar, that's also been pressuring stocks too, because the stock market likes a weaker dollar. But an awful lot of red, mainly with the NASDAQ crossing below significant levels here. And then in Friday's session, we saw a pretty nice little bounce and we saw a lot of green here or blue, depending on what color you see. And you can kind of see this at a glance. If there's a lot of red, it's negative. If there's a lot of green or blue, that tends to be positive. I go through all of the daily alerts in each daily video, so I break it down a little bit more there, but this just gives us a little bigger picture look. Then stockcharts.com also has a thing called scooter scores. It rates something on a scale of 0 to 100. The higher the score, the better looking that particular index. I look at the NASDAQ 100 as represented here by the Qs. I also look at the S&P 500, the Dow, the mid caps, and the small caps. And even though the market's been under pressure, the NASDAQ and NASDAQ 100 have been holding up a bit better. We lost support with the S&P 500 when we dropped through the 50-day moving average. We have not been able to get that back. And as we've been trying to come up in other sessions throughout the week, we've been hitting that 50-day moving average and not able to get above it. Well, the QQQs, or the NASDAQ 100, as well as the NASDAQ, are still above their 50-day moving average. And so we're watching those indexes pretty closely. If we start to go up, that could bring the S&P up with it. If we lose that support level, that could turn things more negative and take the S&P down with it as well. But coming in first place are the Qs at 81.4. Now, when this index is really strong, it'll be up into the 90s, but it's still giving us a fairly good score overall, and the best one this week. In second place is the S&P 500, is represented by the SPY, coming in at 78. Then in third place are the small caps, and this is the time of year when there's a lot of hope that the small caps are really going to do well. The problem is interest rates have been going up, and small cap stocks have to borrow a lot of money because they're smaller companies, and interest rates can have a real impact on their bottom line, and their stocks tend to not do well. Now, if we get into an environment where interest rates start to go back down, and we're looking at some charts that are at some significant levels as far as support for price to bounce back up with bonds, which means interest rates have come down, and we're seeing some overhead resistance where interest rates may top out and come back down. We don't know that, but we're just seeing that on some charts. If that ends up happening, if bond prices go up and interest rates go down, especially if we get under that 4.5% level with the 10-year yield, that could help stocks. If we continue to go up with interest rates, that's probably going to pressure small caps and all stocks for right now. But the small caps are coming in at 73.6. Then we have the Dow, which not so long ago set an all-time high, but it's been under some pressure lately, coming in at 65.7. Then in last place are the mid caps, coming in at 59.5. So there's not a lot of strength right now in these scores. We want them in the 90s for the real leadership areas, and then into the 80s or so, excuse me, with the other areas that may be lacking but are still doing well. All right, then I look at some short-term charts. This is a short-term rainbow, and it goes from 10 periods up to 50 periods with a simple moving average. I changed the color to kind of make it look neat and everything. Well, for a lot of 2024, we've been well above this rainbow. There have been some pullbacks along the way, and where we're at right now, we're wondering, can we get back up above this rainbow? We're below it right now, and that's one of the reasons that the short-term trend has switched over to negative. I use a 20 period moving average to determine if we're positive or negative. We've fallen below that, and we're also below the 50 period moving average. If we can recapture those, that would help things turn back more positive. And there's a solid case to be made for that in some of the other charts that we're looking at. But if this continues to fall, these lines are going to roll over, and that's going to turn the short-term trend more negative. Then intermediate term, another rainbow, going from 50 periods up to 100 periods. We're coming down into the rainbow. Now, this didn't happen all that long ago, and so the lines aren't really starting to roll over yet. We could still bounce up out of this and have the integrity of these lines still going up. The longer we stay in the rainbow, the more these lines are going to roll over. And of course, if we drop below the rainbow and stay below it, that's going to turn things even more negative. So this is just another visual way of being able to see the condition of the intermediate term trend. I do use Bollinger Bands, and there's a lot of different ways that you can use them. How I use them here is to suggest when we're either overbought or oversold. The percent B indicator, which is down here on the bottom, it measures when we're outside of either the upper or lower Bollinger Band. Because if you go back and look, the times that we get outside of these bands, it doesn't happen very often. And when it does, it tends to not last very long. That means the market's getting pretty extreme at that point. Well, we're not extreme right now, so I haven't been showing this chart. The takeaway from this is that we are below the midpoint, and the midpoint is starting to roll over, and that's suggesting that the market has been weaker, which is also being confirmed by other charts that we look at. And we're keeping an eye on the 100 period moving averages. I plot both a simple and an exponential moving average here. We're still above that. That's more intermediate to even a little bit long term. We have fallen below the 20 and the 50, which are the other main moving averages that I use. This would be the next line of support if we continue to fall. If we come off of here, of course, that will keep this chart more positive. Then there's another indicator that I use like an oscillator when we get above or below the black line. It's the CMB composite, and we're just about in the middle now. So it's not necessarily extreme either way. The mass index is not generating a signal right now. We are coming up a little bit, but when we really pay attention to this chart is if we go above the red dashed line and the blue line and then roll back over and start to come down. That could suggest that some kind of trend change is in order, but we're just not seeing that on this chart right now. The Pring bottom fisher, it's the idea is that after we've really been declining, this is supposed to generate a signal. And it does, but sometimes it doesn't generate a good signal, or sometimes this is going down when we do, in fact, hit a bottom. But still, I use it in conjunction with other charts. It actually gave us a pretty good signal here at the end of November. This was the gap up that we had after the election, and then we came back down. And about that time was when we saw a crossover here, and then we saw a nice little run up with the S&P after that. Well, right now this is going down. So we really only pay attention to this when it's crossing back above and starting to turn back up, and when the black line goes above the red line. We measure the distance away from the 200-day simple moving average. We're not all that far away from it, but we're still above it nonetheless. That means that the long-term trend is still intact. Then I do some measurements here, and this is just eyeballed, so they're probably not exact. We look at general gains going back to October 2023 up until Friday's close. And then within that, within the pullbacks, we want to keep an eye on the percentage levels, because if we really start to go down and we get about to that 10% level, that means that if we go over 10%, we're in a correction. Well, that's what happened last summer. We almost got down 10% before we really started to bounce up out of that. And we did set an all-time high here with the S&P, and we've been pulling back, but we're not even close to that 10% level yet. So I just keep an eye on this and use it as some kind of indication. Now, if we do continue to fall, we break below this previous low and keep going down, and we go down more than 10% from the all-time high that was set, that's going to mean that the overall environment is changing to more negative. But right now, it hasn't switched over to that. Another oscillator that I use is the Connors RSI. We look for extreme negative or positive readings here. We're not getting that right now. Use a series of anchored moving averages. Now, the idea behind regular moving averages is that they're calculated on past data, and anchored moving averages are too, but they just calculate up using past data up to the present time. Where anchored volume moving averages, they try to project forward here. And there was a low that was set here and an anchored moving average that came off of that. We're still below it, but that's pretty short term. The takeaway from this is that we're still above all these other anchored moving averages here, and the lines continue to go up. So things haven't switched over negative. If we continue to fall here and these lines start to roll over and we see them bunch up and it turns more into spaghetti, then that would suggest that things are turning more negative. But we're not seeing that at this time. We keep an eye on the S&P 100, which are the biggest stocks that make up the S&P 500. And the S&P 100 has been outperforming, and that's what's really helping the S&P to hold up. Not only when it was going up, but now that we've been under pressure, the S&P 100 has also been holding up a bit better. The large caps and the mega caps in the stock market are really staying together where other stocks are seeing some weakness. But what we look for on this chart are just divergences of any kind, and we're really not seeing them right now. Then I did show this earlier throughout the week because we had a couple of O's drawn. This is a point and figure chart, and this measures upward or downward movement based on the amount of upward or downward movement that happens. It does not take time into account. So these O's could have been drawn over the period of a year or over the period of an hour. It's just looking at price in and of itself. And we are coming back down a little bit as the market's been declining. Overall, we're still pretty positive here. We have a trend line that's going up on as the more X's than O's have been drawn. And so far, even though we're seeing some weakness shorter term in the bigger picture, this is still looking positive. But there's no signal that's being generated right now with this. So it's kind of a neutral reading currently. Then I have another long-term rainbow going from 50 periods up to 250 periods. And even though we've been pulling back, we're just coming into the top end of the rainbow right now. The lines are still going up. Now, if we can bounce back up out of this, that would turn the long-term trend more positive. Now, the long-term trend is still positive since we're above the 200-day moving average, and we're not seeing what we call a moving average crossover, where the 50 period crosses below the 200. We're still way away from that happening. But it would be more positive if we do start to go back up, we get above the rainbow and the lines continue to be smooth and going up. Then we look at a long-term oscillator here. It's called the Special K, and we don't get very many signals with this, maybe one or two a year. And even though it's rolling over a little bit right now, we're still kind of far away from this moving average. So I don't show this chart because it would be the same thing for long periods of time. But I do look at it every day, and if we do see some kind of a signal, I'll start showing that in the videos. Then just to see if things are working in a similar manner between the US and Europe, we look at a weekly chart of the S&P on top, a weekly chart of the German DAX, that's the biggest stock market in the EU. And we see down here that the correlation between the top chart and the middle chart is pretty strong. So they're not really getting out of line with each other. And this is a study that tries to measure how far away are we from various moving averages. And I plot a 20, that's short term, 50, intermediate term, and 200 period moving average, that would be long term. And then use this like an oscillator. When we get too far away from one of these moving averages, this will get a very high reading or a very low reading, and then we tend to stop and go back. We revert back to the moving average. It just means price is going either up or down too far, too fast. We're not seeing that right now on any of the moving averages, so I haven't been showing this chart. Then some support and resistance. This is a 20 period simple moving average of the open, high, low, close. This is more short term. And when we're really doing well and the market's going up, we tend to be above all of these lines and the lines themselves are going up. Well, lately we've dropped under this little mini rainbow And sometimes if we try to bounce, one of these lines may act as overhead resistance. Well, we try to come back up into the mini rainbow and then drop down out of it. We're still below it. And the longer that we stay below this, the more these lines will continue to roll over. If we can get back up into the rainbow and then above the rainbow, that would turn these lines back up. We keep an eye on fib retracements going from the all-time high and then going down the different fib levels. 38.2 would be the first one. Even with the declines that we've been seeing, we're still far away from this retracement level. Some broad market measures, we keep an eye on the relationship between the S&P 500, which is a weighted index, and then those same stocks are measured on an equal weight, where all the stocks are counted the same, and we do a ratio between the two. When this is going down, that means the equal weight is underperforming. To say it another way, that means the really big stocks, they're really leading the market. Well, we've been coming down here as the equal weight's been underperforming, but the bigger stocks have been holding up a bit better. They've been pulling back too, but they've been staying together a little bit. We saw that earlier in 2024, where the big stocks, it seemed like there was just 7 or 8 stocks that were really directing what the market was doing, and the S&P kept going up and up and up because those stocks were doing really well. But the rest of the stocks in the S&P were not doing all that well. Well, then we started to see a shift where this was actually bouncing back up, and we were seeing the rest of the S&P 500 actually participate more in what was happening. All right, then we keep an eye on the Vixen, which is the VIX equivalent for the NASDAQ 100. It measures the volatility of the NASDAQ 100. I don't use this one as much, but I know a lot of you that watch these videos, you do get into the NASDAQ 100, and so you like to keep an eye on what the Vixen is doing. Then we look at some different ratios here. And this is trying to measure, in a way, growth versus value because the QQQs, the NASDAQ 100, that's growth, and the Dow, that's considered to be value, the best of the best stocks. Now, NVIDIA is now in the Dow, and that's a growth stock, but we look at a ratio, and then we compare that to the S&P 500 itself, and we see here that there's a pretty high correlation. That just means growth is still seeing a more stronger correlated relationship when we compare the top chart with the middle chart. And so that's why we're focusing a lot on growth versus value in the studies that I do. Look at the Dow and then the transports. The transports had been doing better, and we're actually starting to outperform the Dow a little bit, but no, they've really fallen back. That's the red line here. And they've been, at best, chopping sideways, and they're going back into the range that they've been in for most of 2024. We keep an eye on the financial sector, and then one part of the financial sector is the bank ETF. A little bit concerned here because we've been really falling back and we fell under the 50-day moving average. We are going sideways right now, but we're in a longer term uptrend. If we can get back above the 50-day moving average, that would mean the bank ETF is looking better. If we continue to fall, we'll be watching the 200-day moving average, which is the red line. And we look at another ratio between regional banks, smaller banks, and the financial sector. And we're in an uptrend here, but we are pulling back right now. We want to keep an eye on this because there was problems with Silicon Valley Bank, Republic Bank, New York Community Bank, and that was really dragging this ratio down. Right now, we're not seeing anything all that concerning. We have been pulling back, but we're still in an uptrend here with this ratio. It would be even more positive if this ratio went up, if something happens. And that's part of the concern with rising interest rates. This could really have an impact on smaller banks. So I keep an eye on this. And if we do start to turn more negative, that could bleed over into the rest of the market. We look at a ratio between staples, which are defensive, toilet paper, toothpaste, and tech, which is the real driving force of the market, which is great when it's positive because that makes the market go up. But when tech is weak, that really can make the market go down. And we're seeing this really going down. We did bounce around over the summer, but now we pretty much have resumed a downtrend. This is meaning that staples, a more defensive area, is underperforming tech, which is a growth area. Then some rate of change charts. I just use these for informational purposes. We look at Friday's close and then go back 250 periods, and we're still tending to go up, and we have been going up. We're pulling back lately, but for the most part in 2024, it's been pretty solid. This is another look at that same chart, but measured in a little different way, going back further. I have a blue line right here, and when we get above that blue line, sometimes that means maybe we're getting a little too strong, but we stayed above this blue line for quite a while. Now we're starting to come under it. Now we're not really changing negative. It would turn negative if we drop below zero. But you can see the context of this is that we're going up, even though that we have been pulling back lately. We keep an eye on bonds, and interest rates have been going back up. And there's a number of different relationships that we follow. We look at 1 to 3 month T-bills, which is cash, and then compare that with 3 to 7 year bonds. When this is going up, that means cash is outperforming on a price basis because bonds have been under pressure, price has been going down. And this could mean that there's an uncertain environment out there that interest rates are going to continue to go up. Inflation, the Fed has come out and said they're raising their inflation forecast out into the future, and that has spooked the markets. And so interest rates have been going back up. This is a bit of a concern to us. In a more positive inflation-friendly environment, we would see this ratio going down. But since it's going up, we keep an eye on this. But we're not necessarily seeing this across the board, and I'll show you what I mean. This is the tips, and these are Treasury inflation-protected securities compared to 3 to 7 year bonds. Now, tips adjust for inflation. And when inflation worries really hit the market, then this ratio really goes up. Well, even though we've been seeing interest rates going up, we're seeing this ratio actually going down. And this is more in the intermediate term here with bonds from 3 to 7 years. But when we go out another step and we look at 7 to 10 year bonds, then there's more inflation concerns. So on the longer end of the yield curve, we have been going up with this ratio. So the market is concerned about this. It would be more positive if interest rates start to come back down and this ratio also starts to come back down. Then we look at the long-term bond ETF, the TLT, and compare it with the S&P 500. The S&P is in red, the TLT is in blue, and we can see there's quite a big disconnect between them. But the longer term correlation is still pretty strong here. It's actually been getting stronger, where we're pretty much neutral right now with the short term correlation. We do that same thing with the QQQs to the long-term bond. On this chart, it's red instead of blue. This is also neutral right now, as we're seeing some kind of a shift going on in the market between interest rates and stock prices. Then we look at the US 10-year yield on top and we subtract the German 10-year yield. And believe it or not, that actually leads to a line that tends to closely match what the US dollar index is doing. And we can see down on the bottom that the top chart and the middle chart, there's a high correlation between them, which is kind of freaky, but again, it just looks at the interplay between interest rates and the US dollar index. We do keep an eye on the 2 year yield. It hasn't been all that helpful to us lately. Sometimes when this spikes up and starts to come down, that can be positive, at least on a short to intermediate term basis for the S&P, but it really hasn't done all that much lately. And then this is a complete crazy kind of way to look at this. We compare US bonds with European stocks, the Eurozone, and the Eurozone has really been underperforming as the European markets have also been under pressure and interest rates have been going back up. And so that's why we're seeing this ratio going down. And we keep an eye on the 10 to the 2 year yield curve. We've gone back to being normal now, and we're still that way. And we've gone back to being normal with the 10 to the 3 month yield curve as well. Then I have something called possible positive scenarios, and we're not really getting much from these charts that I show here. The charts that are really telling us something right now, I use in the daily videos. And these are the percent of stocks in the S&P above their 200-day simple moving average. Even though we've been coming down, we're still above 50. So this is still positive. Where we're seeing other moving averages, the 20 and the 50 and the 100, they've all dropped below 100. That's why things are more negative. If we can go back up, that would be more positive. Now, I use this like an oscillator when we get an extreme positive or negative reading, but we're not close to those, either one of those kinds of readings right now, so I haven't been showing this chart. I use that same basic idea with those stocks above their 50-period moving average for the S&P, getting a low reading here, but not extreme negative. And then the same thing with the mid caps, a low reading but not extreme. And then the small caps, another low reading but not extreme. So thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.